Have you often heard the term quantitative easing? That seems to be thrown around a lot these days. But what is quantitative easing, and should we even be concerned about it? If these are questions that you have, stay tuned. My goal in this particular video is just to discuss quantitative easing. This could easily be a very, very long class, and I do go into more depth when I'm talking about this subject in the classes that I teach, but I just wanted to give a broad, general view of what is quantitative easing. Do we need to be worried about it? Will it make our lives better? Will it make our lives worse? Or is there some combination of the two that may happen either now or in the future? Before we get into quantitative easing, there are a couple of foundational principles that are good to know, which will help you to just understand things a little bit better. When you want to understand basic economics, it's helpful to realize that there are usually two forces at work. The first is supply, and the other is demand. We usually talk about these together, supply and demand. If you have a whole lot of something, that means that you have a supply. You want to sell a particular product. Well, if you have a whole lot of that product, you may try to lower the prices to entice people to buy them from you because there's really not a lot of demand. If you don't have very much of a product and there are people that want to buy that product, we say that there is great demand. We see this a lot with different toys, especially around Christmas time. Every year there seems to be the hot new item that parents have to buy for their kids. Just as an example, I look way back at an example of the Cabbage Patch dolls. Some of you may remember that. There was a time when those things were very hard to come by. Everybody wanted to have a Cabbage Patch doll. Immediately when a shipment would come into a store, those dolls would go away very quickly. This allowed those people that sold the dolls to increase the price because the supply was low, but the demand was very high. The people that make Cabbage Patch dolls thought, oh great, this is going to go on forever. And so what did they do? They produced a whole lot of Cabbage Patch dolls. A year or two later, you would see row after row of Cabbage Patch dolls. Over a period of time, those prices would fall because now you had a really high supply of Cabbage Patch dolls, but everybody who wanted to buy one already bought them and they weren't the big thing anymore. So demand really started to decrease. And we see this at play over and over again. That's what the stock market is. It's just supply and demand. If there is a great demand for a stock, then the price will go up because the supply is either dwindling or considered to be precious. If there is a real supply of stock and not a lot of demand, that's when we see prices go down. So just understanding this concept is a huge part of understanding economics as a whole. Other definitions that may be very helpful to us include monetary policy, and this is usually enforced by a central bank. All the major countries in the world have a central bank. The big bank in the US is the Federal Reserve, or we often just call this the Fed. And what they do is they control the money supply. If there is less money out there, it becomes more precious, and the value of money, in this case US dollars, go up in value. If there's a huge supply out there and not a lot of demand, I mean, we all want money, but as far as inflation and things costing more, the money supply may be decreased. That makes the value of the dollar more precious and then tends to go up in value. And the Federal Reserve controls that. Also, interest rates. What does it cost to be able to borrow that money? Or what will you receive if you loan money to some other entity? The more it costs, the more precious it is, and the more unlikely it is that somebody will borrow that money from you. Or if you want to get a loan, if interest rates are really high, then you might not be as inclined to take out that loan. The inverse is also true. When interest rates are low, then money is considered to be cheaper, and you might be more enticed to take out a loan because the interest rate is a lot lower. Another thing to consider is a thing called fiscal policy. And this is when the federal government, specifically Congress, but then Congress in conjunction with the executive branch, where they come up with these ideas for either making things a lot more friendly by lowering taxes or making things more unfriendly by raising taxes in order to generate revenue for the federal government. So when Congress and the president get involved in this and work together, they create different types of fiscal policy. And this can include tax rates and the types of taxes, as well as spending policies. During times when the economy is very slow, the U.S. government tries to increase its spending. That's a basic Keynesian method. John Maynard Keynes was a very famous economist, and it's pretty much the economic model that's being used in the U.S. right now. What is quantitative easing? This is a form of unconventional or non-traditional monetary policy. The traditional way is for the Fed to raise and lower interest rates. When that doesn't work, they have to use the next trick in their bag, and that is called quantitative easing. A central bank, such as the Federal Reserve, again, which we call the Fed, digitally creates money. When we have a currency that's not backed by anything other than a reputation, that is called a fiat currency. It used to be backed by gold until 1973, but now it's just backed by the full faith and credit of the U.S. government. They create this currency, and then they take that currency and use it to buy long-term securities. This usually means bonds. Now, this has kind of a double-edged effect when they do this. The increase in money is to make more money available, increasing the money supply. Well, when they introduce this into the economy, they buy bonds. When you buy bonds, that makes the price of bonds go up and the corresponding interest rate go down. So you're not only adding money to the economy, you're also keeping interest rates low or having them go even lower. Another form of security is called a mortgage-backed security, or MBS, and some of you may be familiar with those. Individual investors will typically not be involved too much with those products. If things really don't get better, the Fed may go in and actually start buying corporate bonds. Now, some people think, oh great, that will really help stimulate the economy. Other people say, wait a minute, that's fascism. Okay, when the government controls private industry, that's one of the tenets of fascism. A lot of people are really scared about that happening. The goal then is to increase the money supply by putting more money out there, and this is to encourage lending and investing. Now, a lot of that money also makes its way into the stock market, and at the time I record this, the stock market's doing really well. The economy may be in the toilet, but the stock market is hitting all-time highs. A lot of people think this is a bubble, and this bubble is eventually going to burst, and we might see some kind of a meltdown in the stock market. There are other people that say, no, things are going to get better. They're going to justify these high prices. Eventually, companies are going to start to have earnings, and that will justify the lofty levels that we're seeing right now in the stock market. This also adds additional money and liquidity to the economy. So the idea is to make money more available to businesses and even to people. They're willing to go out and spend this money, and that will help to ignite the economy and get things going in a better direction. The hope is that the new money will help to improve the economy quickly. Now, sometimes this quantitative easing, just doing it one time doesn't help. There was a period of time over 6 years when the federal government did quantitative easing 4 times. The desired outcome is to combine the additional money with low interest rates to promote spending and growth. When bonds are purchased in large quantities, and that's what they're doing, they're buying trillions of dollars in bonds, prices go up, which then pushes interest rates down. This then has a tendency to increase the central bank's balance sheet. And I'm going to jump over to another part of my desktop right now and show you what the current balance sheet looks like. One way that you're able to uncover what is going on in the Fed, and this is something that I watch quite regularly, there's a lot of information out there, but it's not exactly exciting information. But we look at this information each day. That allows us to evaluate where things are at right now. But if you want to go find the Federal Reserve's balance sheet, you can just go to Google and you can type in Federal Reserve. You can see I've done this before. This brings up the federalreserve.gov website. We can click on that, and boom, here is the current balance sheet for the Federal Reserve. And this updates usually about once a week to every 2 weeks or so. This chart can be a little bit misleading because it says this number is in millions and this number is in millions. Well, when you take millions and millions together, that equals trillions. So you might think, oh, you just see the 4M over here? Well, that should be 4T or 6T. When the Fed first started implementing QE was back in 2008 after the housing meltdown. And this is when we go back and look at the Federal Reserve's balance sheet. You can see that it increased. And if you want to go to the website and play with this, I provide a link a little later in this video that you can use, or just go to Google and do a search. The Federal Reserve balance sheet really started to climb. This was the initial stimulus package, if you remember that, right at the end of the Bush administration and the beginning of the Obama administration. And everybody was freaking out because it was like, oh, almost $1 trillion. Ooh. Well, that seems like pocket change now compared to what's going on. The Federal Reserve went in and bought a lot of bonds. And so now when they buy these bonds, they have them on their balance sheet. And then there was an increase over a period of time from 2008 all the way up into 2014. They stayed sideways for quite a while, and then they started to announce, okay, we're going to start to unload these bonds into the market. They want to give the bond market warning, and they're not just going to dump them overnight. They may go in and buy them quickly to help push bond prices up and interest rates down. When they start to unwind these large quantities of bonds that they have, they'll usually give a warning first so it doesn't catch the markets off guard. The one nice thing about the bond market, even though in the program that I teach, we really focus on the stock market, bond market investors tend to be quite intelligent. Doesn't mean they're always right and they always make good decisions, but they tend to be more knowledgeable about what's happening. So they pay attention to this, and then through a period of time, we saw the Fed start to unwind the bonds that they owned. Well, then we had 2020 come along, and everything seemed to change. The whole pandemic hit. The U.S. economy was pretty much shut down at that point. Interest rates flew all the way to zero. That wasn't working. So then the Fed had to come in and start buying bonds again. And I'll go through the actual dates of when this happened. They had their initial purchase of bonds. They have agreed to purchase a certain number of bonds each month. And then at the time I record this, just yesterday, a new stimulus package of $1.9 trillion was just announced, and that was passed through Congress and signed by the president. That may induce some kind of QE forward from here. Here's the link if you want to try to remember this. It's easier to just Google it and go look at things that way. The Fed was first created back in 1913 for three main reasons. Now, I teach a whole breakout class on this that's more extended and goes into a lot more detail. This is just a high-level type of video that I'm doing right now. Woodrow Wilson was our president at that time. Back in about 1908 or so, there were some financial problems being experienced. The government, being the government, wanted to come in and try to fix things. Now, some people have a real problem with that. They want more of a laissez-faire, leave us alone type of attitude. The federal government exists just to protect us and just to barely exist on their own. We are based more on a capitalist type of economy, so we can sink or swim by our own actions. We don't need the government telling us what to do or coming in and helping us out if we make a mistake. that falls all upon us. Well, what has happened over the last 100+ years, there's been a more and more of a reliance on the government, which has introduced a lot of these additional programs. And usually there's some kind of an exchange that needs to take place. If you want more government help, you're going to give up some of your freedom. If you want freedom, you're not going to get government help. So there is a trade-off. It's not risk-free. It's not where nobody pays. There is a price to be paid somehow, some way, either in taking responsibility for things yourself and being free about it, or not having as much freedom, but then getting some help from the government. But when the Fed was first created back in 1913, this was to achieve maximum employment. Pretty much the idea was that anybody who wants to have a job can have a job. I would say 4 to 6% of the population is usually unemployed, even when we are at what is considered to be full employment. And the Fed has done an interesting job over the last 100+ years in this category. Sometimes unemployment gets to be very, very high. Other times, we get things to a point where we're seeing pretty much full employment in the economy. One of the Fed's major concerns is to try to get maximum employment. Another thing is to promote price stability, so that we don't have these barrel loads full of dollars when we need to go buy a loaf of bread. One day we go to the store and something costs $10, and then a week later, it'd be nice if what we bought a week ago is still worth right around $10. We don't want prices to go up too far too fast, nor do we want them to fall too far too fast, leading to deflation. Then another area is to encourage moderate long-term interest rates. When the economy really gets smoking and really gets moving, the Fed will raise interest rates to try to slow things down. When the economy is stalling or actually going down, the Fed will lower interest rates with the hope of stimulating the economy. Normally, the Fed helps to control their monetary policy by setting a target rate for short-term interest rates. And I deal with that in another video that I'll have a link to at the end of this video that talks about interest rates and how they influence the stock market and different information you should be aware of, and an interesting website that you can visit. Since the 80s and into the 90s, this has typically been effective. When I was first trying to learn about this and understand the markets, I kept hearing over and over and over, there's going to be inflation, there's going to be inflation. Well, that inflation never really materialized. I grew up in the 1970s when we had massive inflation with no real economic growth, and interest rates were sky high, but economic growth was very low at that time. So the idea that eventually inflation was going to come back was not that far-fetched. But in the whole period of time up until 2021 that I've been studying things, there's always been this fear and this threat of inflation, but it's never really materialized. Here's an example of a chart, and I use this in some other videos, and I look at this chart not every day because it doesn't change all that often, but the red line that you see on this chart is the Fed funds rate, and that's what the FOMC sets as a target rate when they meet every 6 weeks. Sometimes they don't make any changes. Sometimes they make a statement that makes the market freak out or fixate on something. But when we see good economic growth, that usually means the stock market is also going up and interest rates will go up at the same time. When we see the stock market going down, a lot of the time we will also see interest rates go down as well. If you notice on this chart from 2008 up through about 2015, you notice that the stock market saw a pretty good climb, but interest rates stayed right around zero. They were finally raised back in 2015 as the economy started to grow and recover and show more depth. During the period of time from 2008 up to 2014 or so, that's when QE 1, 2, 3, and 4 were being implemented. So we saw all this money going into the market, but we didn't really see a corresponding rise in interest rates. A lot of people during this time were saying, well, the stock market is artificially high. It's just being pumped up by the Fed and all the extra money that they're pumping into the system. And when that money goes away, the stock market's going to fall apart. Well, that really didn't happen. We saw some bumps along the way. There was Brexit that hit the market for a short period of time and caught the markets off guard, but we quickly recovered from that. Then there was also the 2016 election That produced more of an overnight sensation. We went down a little bit, but then we saw the market really take off and start to move to the upside with a corresponding rise in interest rates during that time. With the pandemic hitting and the economy being shut down, way over on the right-hand side, you can see where interest rates have fallen all the way to zero. And in order to help the economy grow, the Fed is basically now out of their tricks. And so if they want to do anything more, now they have to start implementing quantitative easing. There have been some really bad times in the U.S. economy, and there's a case to be made that we might see some really bad times in the future. Other people say, no, everything's going to be just fine. Personally, I don't pay attention to either side. I listen to what they have to say, and sometimes I get some unique insight or something that I didn't think of before that I use in my own analysis. My goal is to make my own decision and then share that with my students and then get them to the point where they can make their own decisions as well. So, good times, bad times, you know I've seen my share. When the Fed funds rate is either at or approaching zero, then they have to jump into their additional bag of tricks and implement what is called quantitative easing. Now, this was implemented in a little bit different way during World War II, but since that time, the Fed has always come out and said, no, we will never do that. We won't implement this. That is too much government control over the economy. We need to let the economy flush itself out and clean itself out. That may bring a lot of short-term pain, but it'll bring longer-term gain. Just as an example, what did President Reagan do in response to the 1987 stock market crash? Absolutely nothing. He said, no, this is capitalism. This is free markets. These things happen. The markets need to adjust from time to time, and so we might see a crash now and then. I'm sorry, people lost some money, but if you just hang around long enough, you'll eventually get that back. And he was right. The government didn't come in and say, oh, they're too big to fail. We got to step in and do something. We've gotten to the point in American society where if something goes wrong, we think the government should fix it. There is another type of thinking that a lot of people implement that say, government, stay away. Just keep out of the markets. Stay away from what we're trying to do here. Yeah, we're going to have some real pain in the process, but over a longer period of time, it's going to be more efficient. It's going to be more fair. We're going to get rid of the dead wood. We're going to do some spring cleaning from time to time. The investments that people have will actually have more real value attached to them instead of this artificial value. So I don't know where you come out. I'm just trying to present both sides. So during periods of an extreme economic crisis, such as 2008, we also saw a real economic crisis after 9/11, but quantitative easing was not implemented during that time. But a more aggressive approach, such as in 2008 and then 2020, was needed. Some people think this is the exact wrong thing to do. That doesn't really matter at this point. It's happening. And with the previous administration in the White House that supported these ideas, and now the current administration who really likes these ideas, this is the leadership that has been elected. So whether they make good decisions or bad decisions, that's more or less on us at this point. We chose these people to lead us, and if we like what they're doing, we're happy. If we don't like what they're doing, well, we kind of have to just deal with it. How we come out as a matter of opinion really doesn't matter. We just need to look at what's happening and then come up with a plan if things shift in a direction that we're not anticipating. So when the government does look to use that more aggressive approach, that is quantitative easing, or we just call it QE. Has QE ever been used elsewhere? Well, yes, as a matter of fact. This whole thing started in Japan in the late 1990s. They were the first to implement QE, and they've done it a bunch of times, but it really hasn't been all that effective. There's a real debate over QE when you look at, is it beneficial or is it not beneficial? Would the government have been better off not doing anything or stepping in and actually doing something? What would the end result have been? There is still the debate going on now when we talk about the 1930s in the U.S. during the Great Depression. Was the New Deal really that effective? Would it have been better for the government to just do nothing? And yeah, a lot of people would have really suffered. A lot of people suffered anyway, even when the government stepped in. In the long run, would things have been better without the New Deal, or would they have been better with the New Deal? Well, we have the New Deal, and it's what it is. And a lot of these government programs that were set up during that time that were temporary programs that still exist today. That's the thing about government programs. They're usually created for a short-term crisis. And then the idea is that once that crisis is over, we will stop with that program. Well, we have this way of keeping those programs going and going and going and even growing bigger over a period of time and having even more power and more control. Some people think that's fine, that there's no problem with that. We need government control. Other people say, no. The government needs to stay away. In 1997, we had the Asian financial crisis. And I remember when this happened. I was kind of new to the markets at that point. I hadn't been studying it for all that long. CNBC would come on with their extra special coverage when the Asian markets opened, and they were doing all this special coverage about what was going on. It was really a mess at that time. But they were the first to go in and actually start purchasing government bonds. Then in the U.S., from 2008 to 2014, there was QE 1, 2, 3, and 4 in response to the housing meltdown. And then in 2020, up until the present time, as a response to the COVID-19 pandemic, QE is being enacted again. Then in Switzerland, now you think of Switzerland, not only skiing and being neutral, and the Swiss franc is usually considered to be a really good currency, their whole secret banking system and everything that they have. They also had to respond to the 2008 financial crisis by implementing QE. They had to do this also. Most major countries had to have some kind of QE implemented as a response to the housing meltdown in 2008. Then in the UK, in 2016, there was a QE program implemented there as a response to Brexit when they decided to leave the European Union. The fear at that time was that interest rates were just going to go sky high. The UK government stepped in and started buying a lot of bonds to keep interest rates low, and it's still debated as of right now whether that was really effective or not effective. There are other times in history, and I just have two that I'm going to talk about here. There's other ones in addition to this, but ones that you may have heard of, where quantitative easing ended up giving way to hyperinflation. And the first one was in Zimbabwe in the early 2000s. We saw hyperinflation in that country. In fact, they got to the point where they printed $1 trillion bill. That would be kind of cool to have. It really didn't work out the way as expected in Zimbabwe. But then another instance was in the 1920s in Germany. That was the Weimar Republic. That was between World War I and World War II. When you see people using wheelbarrows full of Deutschmarks to go buy a loaf of bread, inflation was just sky high, unemployment was sky high. This was leading up to the Depression, and this gave rise to a person who would end up starting World War II, and that was Adolf Hitler. People were not doing good in Germany at that time. Hitler comes along and says, hey, you elect me as your leader, I'll make everything better. Ultimately, in 1933, that's what happened. And at first, it looked like he was doing a really good job. But then he decided to try to take over Europe, and it escalated into World War II, and everything just kind of fell apart on a world basis at that point. And the US and France, which ended up falling during World War II, and the UK had to go in and, with the help of the Soviet Union, and defeat Hitler. A lot of this can go back to the 1920s with the hyperinflation, which can even go back before that. It was really as a result of Germany being blamed for World War I. That led to this really unstable, crazy government in Germany during the 1920s, which then gave rise to Adolf Hitler in the late 20s into the early 30s in Germany. Then we have the COVID-19 pandemic. March 15th of 2020, the Fed announced a QE plan of over $700 billion. That's a lot of money. We're getting to the point where this is happening so often, and the numbers are into the trillions now, that it's like, what's another $1 trillion? We've lost sight of just how much that is. What they started to do was taper off their balance sheet in April 2020. They threw some money into the market with the idea of, okay, now we're going to roll that back. But then things started to not look very good. So then on June 10th of 2020, the Fed committed to buying at least $80 billion a month in treasuries, these are bonds, and $40 billion a month in mortgage-backed securities indefinitely. And so they keep buying this month after month after month, and that's a lot of money. The idea is to increase the money supply and keep interest rates low. March 11th, which is the day before I'm actually recording this, another $1.9 trillion stimulus package was passed, and that may include more QE with that. I tried to find some information about that. Yes, people are going to be getting stimulus checks, but I haven't really found anything about QE happening, but that's very likely. So what are some of the drawbacks of QE? A central bank cannot force banks, the private banks that are out there, to increase lending or force borrowers, you or me, or businesses that we own or work for, to obtain loans, and we can't force people to invest. We can entice them to spend, and they may take some of that money and put it into the stock or bond market, but they may use that money and buy something or pay off some debt or do whatever they want. The central bank, in this case the Fed, can't force any of these private companies to do things. Now, that's changing with a lot of the policies that are coming out in the modern monetary theory that's being implemented by the new administration, which has a lot to do with the Green New Deal and climate change and things like that. There's going to be a lot of pressure put on businesses and people to do things the way the government wants them to. Some people think that's great, that's wonderful, that's going to be the answer to everything, where other people say, okay, we're turning into Germany in the 1930s or Italy in the 1920s. Is that what's going on here? The government seems to be controlling everything these days. Is that really what America's all about? So there's a real debate going back and forth. The thing that bothers me is these things are happening and a lot of people don't even realize it. They're focused on things that really don't matter instead of looking at things that really do matter and are going to have a real impact on them without them even realizing it. And when they finally do realize it, then it's going to be too late to do anything about it. And that's the real motivation that I have for doing these videos in the first place and having the program that I have where I teach people about these things. This can also lead to a currency crisis. Death of the dollar is coming and we're going to have the Amero and the dollar's going to get wiped out. That may happen at some point, but it's not necessarily happening right now because the US dollar is the least terrible currency out there when you compare it to other currencies. Now the euro is doing really well. It's doing better than the dollar right now. So you have two currencies out there right now that are not really all that great, but they're sure better than the alternatives. One of the drawbacks of QE is that this devalues the dollar. And again, go back to the idea of supply and demand. If you have a whole lot of dollars out there, they're less precious. So they become worth less, not worthless, worth less. When you have less dollars out there, they become more precious. So they have a tendency to increase in value. But with all this stimulus and all this QE going on and all these lower interest rates happening, a real concern right now is the value of the US dollar is going to fall. And it has. Since the pandemic came out, the US dollar has fallen about 10%. It was right about 100. I look at a thing called the US dollar index, and it was about at 100 at the beginning of the pandemic, and it's right around 90 now at the time I record this. So that's about 10% that it's fallen. Is it going to fall further? Is it going to go back up? We don't know at this point. We just need to watch these things and then figure out what we're going to do if a certain scenario plays out. If you do have a devalued currency, as the dollar continues to fall, companies tend to like this because of the conversion rate. It looks like they have more dollars when they convert from one currency into another. A company that produces something in the US and then sells that to another country, those goods are cheaper and people are usually more willing to buy those goods. Now, the inverse of that is also true. Companies that get things from other countries in the form of imports, those things cost more. And so it's kind of a double-edged sword. When QE is enacted, there's also a potential risk of inflation. That's where you have the value of the dollar going down as interest rates go up, or even hyperinflation, when inflation is just out of control. It's just going up and up and up, and you have to look at the currencies like every hour is changing, or every few minutes the value of a currency is changing. That's happened in history. Or then you have this other thing called stagflation. That's what we had in the 1970s. You have really high interest rates, but not economic growth going on at the same time. Where at least with inflation, you have interest rates going up, but you also have the economy going up at the same time. The idea is for the economy to outpace inflation. However, since 2008, these concerns have not really been a big problem. I kept watching for this. I saw all the extra money from QE 1, 2, 3, and 4 that the Fed was pumping into the system. I was really concerned that inflation was going to really take off. It didn't really happen. We saw gold go up a little bit, and then about 2012, when everybody decided to jump into gold, then it fell back because the markets have a way of doing the exact opposite of what the crowd thinks it will do. As I record this, stimulus checks that have been already sent out to people, with now a new wave getting ready to be sent out, that are issued by the U.S. government, they give money directly to the people. This is what can really cause inflation. Now, are $1,400 checks going to have that big of an impact? That is yet to be seen. It depends on what people do with that money. At least when you're controlling this through the banks, there's more little tricks that can be played. There's more control. When you give money to people, you really don't have any control over what they're going to do with that money. Some may save it, some may spend it. Who knows? Everybody listening to this has probably done something different. And then some fear that this may cause inflation. We'll have to see how that plays out. That's why I watch these things closely. What is the conclusion that we can reach from all this mess? QE has been implemented numerous times in the U.S. 4 times back in response to the housing crisis, and at least 2 times, probably more than that, as a response to the COVID-19 pandemic, and who knows what will happen into the future. QE is currently being implemented to combat the COVID-19 pandemic. Then the risk of inflation or stagnation is present, but it's not really been a concern to this point. What I'm telling people to do is have a plan in place in case actions are needed. If you don't know what that plan is, please consider becoming involved in the program that I teach, where I talk about these things on a daily basis. I talk about them weekly. There are other videos that I have on YouTube that you can watch. There is information out there. But first of all, we need to know, is there going to be a problem? What are we going to do about that problem? I'm suggesting there could be a problem. So we better start preparing just in case there is. If there's no problem, we can just keep doing things the way we're doing them right now. If there is a problem, then we have a plan B, a plan C, and maybe even a plan D. What do we do next? So that we're not caught up in this mentality of, oh my God, I didn't see this coming. Because we have money, we have investments, we have houses, we have businesses, and we're stewards of that, and it's our responsibility to take care of those things. What if something bad does happen and the government can't do anything to help us? Or what if we get somebody that's in leadership that's more like Ronald Reagan, who just says, we're just going to let this play out. The government's not going to step in and help. And that could really suck for a lot of you, especially those of you that have come to really depend on the government for help when things get bad. Now, other people are like, yeah, that's what we need. We really need this economy to flush itself out at times. I know it sucks in the short term. It brings a lot of pain. Some people lose their houses, their businesses, their jobs, their life savings. But over a longer period of time, it produces a stronger economy. So where do you come out? And only you can answer that question. So then what I do is I constantly watch these things as the story unfolds. And I'll post other videos on an as-needed basis. I talk about this in the daily and weekly updates that I do on a more consistent basis, but look for information. Thank you very much for taking the time to watch this video. I appreciate you listening to what I have to present. If you desire to, please click a like or even a dislike and the button right below this video. That would really help things out. Please leave any comments. That's what will help me the most. I need lots of feedback. I want to hear, did you like this? Did you not like it? Did I stumble over my words too much? Is it too disorganized? Or did you find the way that I explain things to be beneficial? I can handle it. I've been teaching for a long time. I can handle the good and the bad. I just see it as constructive criticism when it's negative, and I'm very appreciative when it's positive. Also, consider subscribing to this channel and click on that little dingy bell down there to be notified when new videos are posted. At the time I record this in March of 2021, the goal is to post about 3 videos per week on a whole lot of different topics. And these are all free. I'm not trying to sell you anything. My goal is really to pass on information. I do have a program that you can get involved in, and I would love to have lots of people involved in that program. Right now, these videos are really just to help you. Thank you very much. Please look at some of the other links that are listed right here at the end of the video, and I will talk to you next time.